The confirmation arrives at 11:43 p.m. You read it once. You do not read it again. You are 23. You have just deployed $3,200 out of a savings account you had ring-fenced. 14 months of $41,000 base. The residual balance triggers a brief recalculation. You complete it. You move on. The instrument is a diversified index ETF. Expense ratio, 0.03%. You process that figure the way a surgeon reads a complication rate, not as a warning, as a clearance. DRIP is enabled. Dividends reinvest automatically at next available price. No further input required. You have structured it that way on purpose. Your mother's prescription costs increased $140 a month. You have run the numbers. You have not returned the call. You generated $4.11 in passive yield overnight. You will think about that figure more than you have ever thought about your W-2. $3,200 is no longer a balance. It is a position. It will compound on a Tuesday in 11 years while you are allocated elsewhere, and it will have been compounding the entire time, without requiring your authorization. You close the tab. The position does not register your exit. You are 24. The raise was $2,100 annualized. You allocated the full increment the day the new comp posted. Not a budget revision, a protocol. Payroll triggers 3 automated transfers prior to discretionary clearing. ETF receives first priority allocation. High-yield cash reserve receives second, accruing at a fixed APY against a floor you have not revisited. Third, reinvestment into the digital asset currently generating $11 weekly from counterparties you have never spoken to. The inflows are uncorrelated. The protocol does not distinguish between good weeks and bad ones. Aggregate monthly passive income across 3 streams, $38. Monthly rent obligation, $1,150. You have priced the spread. You are not deterred by it. Deterrence is not a variable the protocol recognizes. She surfaced the condo on a Thursday at 7 p.m. in a parking lot. Engine running, bags in the back. Appear from her program. Just closed. She delivered the information the way people deliver information they intend to be heard twice. You said you were working on it. This was a true statement. It was not responsive to the question she was asking. The tax refund has been allocated. The question your partner asked was not a question about capital. You processed it as though it was. $38 a month becomes the benchmark. You reclassify it as structural, not supplemental. You are 27. Unit 2 has been vacant 5 days. Unrealized yield drag, $156 per day. You adjust the pricing model at 11 p.m. from a unit you moved into 4 months ago, operating against a HELOC drawn on a co-owned property to fund 3 arbitrage positions you lease but do not hold title to. You have the square footage on all 3. You have not been to any of them. A 1031 exchange deferred the tax event on your fractional real estate disposition. You did not originate the structure. A secondary source flagged it. You spent 11 days in due diligence and executed within the quarter. Monthly passive income, $1,240. Net worth, marked to model, $118,000. She asked for the plan on a Sunday. Not the model, the plan. You opened the model. You walked her through every line. She received all of it. She asked again. You opened a second tab. Your brother classifies it as a business. You have not corrected his taxonomy. You are certain the word appears in none of the operative documents, not the HELOC agreement, not the lease addenda, or the platform terms, and that none of those instruments have an opinion about what he calls it. You are not a landlord. You are an allocation decision wearing a person's calendar. By 29, 3 operators hold licenses to execute your arbitrage playbook. Royalty rate, 8%. They initiated contact. You issued a document. You received executed agreements and wires. The structure is now self-replicating. You earn from the system and from others running the system, a distinct income category, not because the quantum is larger, but because the mechanism is optimized for your absence. When the system runs without you, you are no longer a cost center. You are infrastructure. Your father had a cardiac event on a Wednesday. He is stable. The term long-term care entered your working vocabulary 4 days later on a call with your brother, framed as a funding gap requiring a projected cost structure and a drawdown schedule. Your brother went silent when you said the word structure. You completed the sentence. He said he had to go. You sent the PDF that evening. He has not opened it. You are running, nearly verbatim, a conversation someone ran on you 3 years ago. You did not identify the pattern until now. You are 31. The wire was $200,000. Memo, real estate tech venture. He asked one question about unit economics at a conference convened for an unrelated purpose. Your answer was correct. 14 days later, the capital cleared, and you held outside investment for the first time. A third-party thesis you were now obligated to validate or write down. You wrote the spec instead. The product, property management SaaS, small landlord segment, $89 monthly subscription. 8 months in, $44,200 MRR, churn at 3.1%, net revenue retention above 100%. Personal draw, $9,000 a month. The last time you derived an implied hourly rate, the output was not credible. You discontinued the calculation. The eviction workflow feature was a single sprint, automated, templated, jurisdiction-specific, self-executing. 3 customers surfaced the requirement in the same week. You scoped it. You shipped it. You have not thought about it since. It has executed 1,400 times. A tenant in Phoenix was locked out on the 14th. The notice was compliant. The timing was within spec. The feature performed as architected. At $44,200 in monthly recurring revenue, you are not operating a business. You are managing a contained economy with its own internal weather. A close friend accepted an offer at a firm. Total comp, $310,000. He disclosed it at dinner. You processed the full position. You felt no competitive pressure. The absence of it was notable. It arrived without a trigger event, without context. You analyzed it on the drive back the way you analyze an anomalous retention cohort, looking for the signal in the deviation. You have not reached a conclusion you trust. There was a funeral on a Saturday in March. You were in a deployment review. You dispatched flowers via a 4-star rated application. You verified the rating before initiating the transaction. You are 33. The term sheet is on paper. No one requested a hard copy. Someone on his team printed it regardless. It sits on the table between you, creased from transit. The founder is 26. He activates a recognition you cannot source. You take pro rata rights as a standard covenant, not a concession. He accepts without negotiation. You log that. The log is not favorable. Passive income is running at 6 times your original W-2. Deployed capital across vehicles, $1.2 million. The SaaS carries an unrealized gain of approximately $2.8 million at last informal mark, a figure that exists in a cap table and nowhere else until an event makes it real. You passed on a founder last month. His unit economics were cleaner than yours at a comparable stage. His presentation was not. He lost the thread twice in Q&A and recovered both times, but slowly. You wrote execution risk in the ride-back notes. That is not the complete finding. You have not revised it. You are no longer deploying capital. You are selecting which structures will remain solvent after you are no longer a counterparty. She received the offer on a Tuesday. $287,000 total comp. A market where the cost basis on residential is 40% below current. A title representing genuine career progression. The conversation that followed mapped onto a structure you have run before. Anchoring position, implicit BATNA, the held silence that signals the other party is waiting for you to move. You did not name the pattern. You asked which neighborhoods she had identified. You pulled the comps while she was still talking. You did not disclose that either. You are 38. AUM, $14.3 million. You authorized 3 allocation decisions today that will not be adjudicated correct or incorrect until you are 53. The LPs are already on their phones. You stand. A portfolio company reduced headcount by 34 on a Wednesday to clear an EBITDA covenant ahead of a secondary transaction. You had visibility into the cap table math 3 weeks prior. The mezzanine tranche returns an incremental 180 basis points if EBITDA clears the threshold. You were not present at the all-hands. You were not invited. The secondary wire cleared at $2.1 million to the fund. You initialed the distribution memo the same afternoon. 2 letters. Less than 1 second of execution. You initialized the DRIP at 23. You are still initializing it. The asset class being reinvested is no longer dividends. The net worth document has exceeded single-tab capacity. You migrated the overflow to a second tab and updated the consolidating formula. The summary figure is accurate. You have verified it twice. You have closed the file. Your mother's contact record carries a photo that is 3 years old. There is an unread, technically, message from her timestamped 14 months ago. A Thursday. A domestic question. Response time required. 10 seconds. You opened it. You did not respond. The prescription plan has been active since 2019, funded and automated, dispersing without manual intervention. You structured it to run the way the drip runs, without requiring your presence. You categorized that as equivalent to a response. You have not stress-tested that conclusion. The structure operates in your absence. That was the design specification. You have achieved it. What the achievement now requires of you is not defined in any document you have written, and you have 17 minutes before the next calendar block opens. She is 24. The brokerage interface has been redesigned. The underlying settlement logic is unchanged. Last month, she generated $312 in passive yield without active management. This month, she initiates her first automated wire, $47, into a position she will not liquidate. She has recorded the word automated in her notes 3 times across the last 2 weeks. She underlined it once. The underline was not premeditated. It was nonetheless made. DRIP is enabled. The ETF holds issuers she has views on. She has not cross-referenced the holdings. The confirmation screen is blue in the dark of her unit at 11 p.m. She reads it once. She does not read it again. Somewhere inside a structure with no user-facing visibility, a mechanism that has been running for 15 years receives her $47 and does not log the event as significant. She is not modeling the structure. She is looking at the number. The structure was never designed to require her to understand it. It was designed to run.